Hello, good afternoon. You're watching Closing Trades on ET Now. I'm Anisha Jain. With me, Sekunj Dalmia as well as Aisha Faridi. And the closing trades for now are telling you that after that sharp consolidation that we saw during the trading session today is now recouped a bit. At least we're off the lowest point of the trading session, managing to hold to that 20,000 mark. However, there's a very sharp profit booking that we witnessed today in the broader markets. Can say that it was coming because of the fact that the small cap and the mid cap indices have run up over 30% this year. So not a complete surprise, but the pace at which it was coming down and the quantum is something that surprises Street a bit, because at one point of time the small cap index was down as much as 4%. Separately, autos have been very volatile on account of that entire news flow and the flip-flop around the 10% additional duty on diesel engines. So we are watching out for that. IT, that's the space that we have been highlighting throughout the week, talking about how there has been large deal wins. TCS is likely to back some fresh orders in US as well, and that entire space is bucking the trend. Having said that, Aisha, it's Reliance, HUL after that weak Q2 commentary, and then NTPC that continue to be the top drag at the index level.
Yes, they do, but kudos to the way L&T has contributed to today's move from the word go. Really, this has been one of the stupendous most performers, inching closer to that 3,000 rupee per share mark. And IT, that's the other pack which is holding out just so smartly. TCS, Infosys, the entire pack is struggling along nicely. But like Anisha said, there is a whole lot of market which is in the red as well. But let's talk about some of the specific newsmakers then in trade. And it's got to be autos, right? And especially the kind of volatility that you saw. Nitin Gadkari is saying that they're going to propose a 10% additional GST on diesel engine vehicles and genset, and then the clarification that came by that no such proposal is currently under active consideration by the government, however. But yes, it sure did take its toll on the auto majors, and then they recovered a little bit as well. Having said that, they've been under pressure from the word go today. BEL, an interesting note from Axis Capital, they're targeting mid-teen revenues CAGR over FY 25 to 26. They've downgraded the stock to now a reduced target put at 143, and you can feel the heat on BEL, which is down nearly about 7% as we speak right now. Laurus Labs too downgraded sell, target though unchanged at 300 rupees. Kotak says that they've rallied after a washout first quarter and on worst is behind narrative, which is unsustainable according to them. That stock as well, as you can see, is under pressure. L&T though, they've revised the buyback price to higher now to 3,200, and that clearly is adding as a fillip to one of the big Nifty heavyweights, which has been a big mover, like I said, from the word go today. But yes, lots has happened actually from the 20,000 mark, Nikunj, that we opened at. That big bout of correction that happened in some of the frenzied sectors, your railway, power, defense names, big cool off coming in, some mild recovery. But that's a telling sign as to where you need to, if you're a near-term player in the market or a short-term player in the market, you need to protect your profit.
See, Aisha, they had become Humpty Dumpty, and Humpty Dumpty will have a great fall. That does not mean that they cannot recover from the fall. But for me, while we can talk about railways, we can talk about defense, for me I think the overarching theme is what is happening to the penny stocks. The real true indicator of the market mood. So whether it is single digit power stocks, single digit metal stocks, single digit construction names, that's where I think the reversal is very, very sharp. Suzlon's lockdown, I think. You got JP Power, look at JP, you look at Reliance Power, look at Ratan Power. That entire cohort, which in a sense could be called as trader patronized single digit stocks, that's where the reversal, I guess, has happened. Now, the Nifty has not fallen. So the call is, since Nifty has not fallen and Nifty in a sense has lagged this entire market momentum, could there be a situation where markets will fall? I'm talking about mid and small cap stocks, and then they start consolidating and money will start rotating from mid and small cap stocks back into some of the large cap stocks. Or this is day one of what could be called as the excesses in the market getting flushed out, and the excesses may just extend themselves, and this flushing out system may just extend itself for next couple of days. Kunal, I was just looking at the data. Historically, we've seen large cap stocks, they fall, and then mid and small caps, they fall. Right? For the first time it's a rare instance that small and mid cap stocks have fallen and large cap stocks are holding on. Do you think there could be a situation that because large cap stocks have not fallen, the base in mid and small cap stocks will be discovered soon?
Well, yes, seems likely, Coach. And So to add to the point, even in this last leg of the market uptrend, it was the large caps which underperformed, and mid caps which went through the roof for many of the spaces and many of the sectors. Now, I think that's one of the major reasons why the markets are getting into a bit of a corrective mode today. And I'm not talking of the indices specifically, but the market breadth as such. Look at the pockets of sell-off, the likes of even if you look at the top 4-5 names on the future side, you have the likes of BHEL, PFC, REC, etc., BEL, and these are the ones which had rallied up exceedingly high in the last many weeks as well as over the last many months. So there's bound to be a bit of profit booking, and I don't sense that this could just be a one-day profit booking. I think it could be a process of say another 3, 4, 5 days or another week where these stocks would see some bit of more selling pressure. So in case if these stocks see a bounce, which should be a natural case after such kind of a sell-off, that would be probably taken as an opportunity to try and exit positions. But the other point is also very valid, that large cap stocks should see a lot of stronger buying as well as a decent pattern going forward. So even the likes of ICICI Bank, HDFC Bank, etc., Reliance Industries could be another stock which I believe could probably try and get into a bottom formation zone. ITC has managed to protect its 440 mark, looks attractive. So FMCG, IT, mix of those underperforming stocks from the private sector banks, I think all of these stocks should make a decent comeback.
Have you started going short?
No, I've started to book profits on the mid caps and small caps.
So you're not going short in any of the stocks?
No,
Even
no.
defense?
No.
Even power?
See, the stocks in defense, for example, BEL and HL, they're the ones which are in FNO. Most of the other names...
Intraday you can go short. I mean, markets are looking so weak. I mean, tomorrow morning we'll just go and sell railway stocks. You won't do that?
No, I won't do that.
Why?
No, because my sense is that most of the defense names, for example, they are like BEL and HL. They are the two candidates which I keep on advising. They are typically very low beta, and when a low beta stock falls by 7, 8, 10%, you don't have higher risk reward to create fresh shorts. You can't expect these stocks to fall by another 7 or 8%. And if the meat is around just 2 or 3%, I think it's not a lucrative trade to go short.
Nuresh, what is your sense? I mean, it is just one of those bull market corrections that very sharp, by the time you react, that's going to be over. Because the selling has been quite excruciating, if I may use the word.
So the reason is, if we look at selling is generally much larger in terms of a single day move. Any big downtick is generally more than an uptick. So on 25th August, when Nifty made a bottom around 19,250 odd levels, the Nifty small cap 100 made a bottom around 11,800. And yesterday it came very close to almost 13,000. So that was a 10% move on the small cap index in the last 2-3 weeks. And even today, after the fall, we are closer to 12,500. So we've only retraced half of it. But it's just that if we went 10% over almost 10 to 15 sessions, we've lost 5% from the top in less than one session. So that's the case. But even today, the index is much higher than where it was on 19,250 level. So the whole outperformance in the last 2 weeks of the BSE small cap, the Nifty small cap, has been normalized with the Nifty coming to 20,000. So it's almost a similar 4-5% move on both the indices. So a classical case of fading of over excesses in the system. Now going forward, we look at whether we hold on to that 12,000 mark till the time we are above the 12,000 on the Nifty small cap 100. And we are about 19,600 on the bank Nifty. The bias remains positive. It could be just a shake off of 2-3 sessions.
I mean, look what's happening to names like BHEL, for instance, today. And that really gives you a sign of that sheer, let's just our profits, the market has run up too much. BHEL is now down almost 9%. Look what's happening in an REC and a PFC. Both these stocks, significant run up past fortnight. They're down anywhere between about 7 to 7.5% apiece. I can say the same about BEL. Sure, there's a downgrade coming in on that stock today, like I earlier highlighted, but that's also down a good 7% too. Kunal, anywhere between the power cap goods where you would say at least book your profits?
Well, definitely the power finance names, for example, REC, PFC, definitely a good zone to book out profits. Even the smaller cap names like Nikunj was alluding, JP Power, I think Ratan India Power, and many of these stocks which are run exceptionally high, and I think for no reason as such, are also the pockets where I think traders should start booking out profits and get back into that the theme of large cap names. I think that should be the tonality of the markets going forward. We've seen that happening. So even when the index corrected from 19,900 a couple of months back, there was a definite change of tone for the sector performances. Bank Nifty, which was a stronger sector there, started to underperform, and then you had Nifty IT index, etc., started to outperform. So I believe that in this leg of maybe a correction or a consolidation for the index, you would bound to see this sector change coming across, where mid caps and small caps should underperform and large caps should make a strong comeback.
Okay, so that's the take coming in. But Naresh, what's the view on IT pack? Today, of course, TCS is reacting. There was a news flow that came out that TCS could be one of the likely winners for some of the orders in the US, the ones which are going earlier to the Chinese companies as well. Apart from that, which are the stocks that you like?
So TCS has given a good breakout today. Previous high was around 35.50 levels back in February. Again, we topped out around 35.30 levels in July. So we are making almost a 2-year high on the stock. And in the previous cycle, TCS was an underperformer in the 2020-21 cycle. So it's taking the lead here. So clearly a leader in the large cap space. Finally, one of the few large cap names which are making 2-year highs. So TCS remains the top pick. Continue to like HCL Tech, which is another stock which has been holding on above the 1200 mark, which was the high for the last 2 years roughly. So TCS, HCL Tech, and then if one is looking out for a bounce back candidate, would be Wipro purely because it has corrected the most. So this would be the 3 names, and overall IT as a pack has started seeing one by one different stocks making different price actions. We've started seeing large caps also take leadership. So TCS on dips still remains an interesting trade after today's price action.
Thing that we were earlier chatting about in the morning, some of the private banking names are still holding on to their gains. And Naresh, you flagged up off ICICI Bank, right? If I recall, still holding on to its gain in an otherwise kind of cooling off market. What's the next price target in the very near term?
So ICICI Bank, if we look at the stock price, it topped out at 960 in December 22, then again at 860 in May and July. And for the last almost 2 months, it was doing 960 plus minus 20 points. In the last 2 sessions, it has broken out. The previous highs made in July were closer to 1006, 1010 levels. So if it sustains 1010, it could be a fresh breakout, a momentum trade where it could go towards 1050, 1100. So ICICI Bank looks interesting. Axis Bank hit a new all-time high yesterday. Today also is holding on. IndusInd Bank above 1430. So the whole private bank looks interesting. Apart from that HDFC Bank and Kotak Bank, which are recoveries from the bottom, but the other private banks like Indus, Axis, ICICI are actually knocking at 52-week highs. So they look very promising.
Let's take a break. But you got banks which are holding on, IT which is holding on. Now, who's buying? I don't think DIs are going to be buying TCS or ICICI Bank on a day when markets have fallen. It clearly means that somewhere from the FI front, either money is rotating or money is genuinely coming back. Typical market action, if there is excruciating fall in small and mid cap stocks, and if the leverage concerns are not there, if the global concerns are not there, markets will rotate back to normally to defensives, but right now I think it's going back to banks. You know, I think that if you ask me what is the new defensive banks? Yeah, I mean, just think about it. I mean, what is defensives? Defensives is something where you can predict earnings visibility. Why did you call IT and pharma defensives? Because, see, defensive, they were called as IT and pharma and FMC defensive because consumer story in India is intact, global story in IT is intact, and the pharma outsourcing story, at least a couple of years ago, was always intact. You were unable to predict the earnings for metals, infrastructure, autos, and to some extent banks. Now, where can you predict the earnings? Banks. Can you predict the earnings in IT? You can't. Can you predict the earnings in pharma? You can't. Can you predict the earnings in infrastructure? To some degree, yes. But infrastructure is a debt. So I will not call it defensives. But where are you confident of trends in terms of momentum? Where are you confident in terms of balance sheet expansion? Where are you confident of low NPA and high retail growth? Banks. So in my book now, banks are the new defensives. It's a new one. But yeah, I think that is the one that could be at play. Let's take a break. When we come back, we'll take this theory forward. Are banks the new defensive?
Back with closing trades right here in ET Now. Still trying to latch on to that 20,000 mark, at least for the Nifty futures. We are staying put at that level. That, of course, is the Nifty Bank. That's also covered its losses from earlier today. But yeah, the Nifty futures are still holding on to 20,000 and we are back at that mark for Nifty Spot as well. Let's see whether for a second consecutive day we're able to close above that mark or not, given the kind of cool off that you had in the first half of today's trading session and the recovery then thereof. While TCS, L&T, ITC, Infi continue to support the market, BHAL, REC, PFC, BEL, NCC, GMR Infra, you know, these extremely exuberant mid and small caps are the ones which are seeing a massive bout of correction. But let's figure out what else lies ahead. Rakshit Ranjan of Marcellus Investment Managers joins us on the show right now with his take on the markets. Rakshit, hi, afternoon. Good to have you on ET Now today. Rakshit, your take on the market right now. Protect capital, book some profits, at least when it comes to mid and small caps, or do you think this is just a one-off aberration that we are seeing?
Good afternoon. First of all, thanks for having me on your show. Now, the answer to your question, I think, is also it needs to be contextualized in terms of the exposure that you already have. If you've got exposure in areas where there has been a massive re-rating upwards of multiples, or the earnings had a tailwind to itself over the last 1 to 2 years, which perhaps is a tailwind from the external environment. So you were in a commodity upcycle as a commodity producer, or you were let's say a highly leveraged maybe a bank with external environment becoming more and more benign in terms of NPAs, etc. If those are the exposures of the investor, then I think it's better to book profits, certainly. But if your exposure has been to sectors where fundamentals have actually run significantly ahead of share prices, so for instance, you were talking about the kind of stocks that are doing well on a day like today, you would actually invest more and more there, because there are segments of the stock market which in the last couple of years haven't progressed in share prices with the fundamentals. Those are massive opportunities to make money. So I won't say the market is overvalued as a pack. There are segments that you should not have exposure to, in my view, and there are certainly segments that deserve more and more exposure at this stage, given what has happened in the last 2 years.
So can you be slightly more specific here? I mean, is there a list you can share with us, what to avoid and what to buy, where to reduce, where to add?
Sure. So for instance, talking about the lenders, I think private sector banks versus public sector, right? That's a massive, I would say, difference between how in the last 2 years an HDFC Bank or Kotak, and by the way, as a disclaimer, these two banks are part of our portfolios, our clients' portfolios, our families' portfolios. So an HDFC Bank or a Kotak or a Bajaj Finance, compared to some of the other banks which have had a great rally in the last couple of years, but not for reasons that can be sustained for the next 5 to 10 years. Talk about, say, some of the consumer discretionary companies, some of the retail plays where there was a lot of noise in the last couple of years because of either COVID-related impact or input cost rising, and hence last 12, 18 months margins were depressed, but those are not sustainable factors. Margins will recover or have already recovered, etc. So yeah, I mean, so for instance, the likes of say in our portfolio, Page Industries, Asian Paints, an HDFC Bank, a Bajaj Finance, etc. Those are some of the stocks we have exposures to.
The raging debate in the market is whether the mid caps are expensive or not. Yesterday, of course, we had Sanjeev Prasad Kotak Institutional Equities dropping their mid cap recommendations, saying they're running out of options. What are you doing with your little champ portfolio? Are you also running out of options, or which are the spaces where you are adding there? Because I remember that chemicals, financials, industrials, these were your overweight sectors there.
Yes, so we are making changes because when you're in the small and mid cap, then I guess the frequency with which you need to sort of change with the changing dynamics of the companies and the businesses, the industries in which they operate is also a little higher frequency. So yes, for instance, in some of our companies, we have some of our smaller mid cap portfolios. More recently, we have added Trent as a stock, the West Side Zudio retailer. We have added one hospital retail, hospital chain to our portfolio. So those are some of the additions, for instance, and we have trimmed or exited from some of those sectors that you just mentioned that we had significantly higher exposure to previously. But yeah, those are some of the pockets as examples.
Understand trend. I mean, I was looking at numbers. It's at what, 120 times 1 year forward. History tells us that when you buy stocks above 50, 60 times, you don't make money. This is 120 times.
Right. So that's very interesting. Two ways to understand that. One is, if you remember, 2 years ago, approximately 2 years ago, Titan was at 2,000 rupees a share when it was 250 times trailing and maybe about 100, 150 times 1 year forward. Since then, it is up 50% and PE multiple has actually derated, right? Because the earnings was not a normalized earning. So when you look at a business like Trent, first and foremost, Ind AS, the accounting standard 116, has ensured that if a retailer expands store count aggressively, then rental bookings, which are more linear on a cash outflow basis, on the P&L, they need to be recognized upfronted. So your costs are high as a non-cash item under Ind AS 116 if a retailer expands store count and takes on more leases at an accelerated pace. So just for that, suddenly you realize that there's a good 30 to 40% drop in the PE multiple suddenly when you normalize for cash element or go pre-Ind AS and normalize it for that aberration. It's an aberration. It's an accounting aberration. Secondly, the next big thing is this is a retailer which is growing profits, revenues at a rate of 35, 40, 45%, depending on which business model of this retailer you're talking about and whether revenue or profit, etc. It's a high rate of growth. So the rate at which this PE multiple falls from 1 year trailing to 1 year forward to 2 year forward is a very rapid rate. And as a result, a DCF captures the true value which a PE multiple doesn't for such a business where near-term growth rate is far more accelerated variant of a normal business of this size. And there's also one other piece worth bearing in mind. There's an optionality here on Star Bazaar, the retail format, which till last year had been experimenting, and by means of doing those experiments, there were some losses. If you believe that those losses will be reducing significantly because the experiments are approaching a steady state proof of the concept, successful retail format, which we do, which that's what we believe, then suddenly the normalized earnings, it goes up. So what you're talking about as a PE multiple is on the face of it. But the moment you normalize it for how the P&L is going to look like, adjusted for aberrations, you realize that the real PE multiple is actually much lower than that.
Okay, point taken. You were also talking about some of the hospital chain companies that you've added. What's the name there, and what's the view on IT? Are you incrementally getting positive there, adding on to your positions?
IT, yes. So, for instance, TCS is in our portfolio of large cap consistent compounders. And then we have LTTS, Tata Elxsi in some of our other portfolios. And again, disclaimer, clients, families, and ourselves, we have exposure to these stocks. So these are some of the names on which we have increased our positions over the last 12 months incrementally. Because the concern of the market was US going through recession and hence let's exit IT, etc. That gave us some opportunity, some pockets to increase exposures in some of these areas, which we've done, wherever we see the resilience being there to the businesses. The hospital chain, actually, I'll have to check if we've disclosed the name or not yet. But yeah, it's a sort of mid-sized South India-based hospital retailer, and these are businesses which are coming of age in the sense that the demand side, which is, let's say, the patients walking into a hospital to get treated, is moving from mom and pop setups or unorganized setups to more formal, experience, service oriented setups, which at times even end up creating a brand recall, etc., etc. But more than that, you get services that mom and pop standalone labs don't, standalone setups of smaller hospitals or clinics or nursing homes don't provide. And hence, provided a hospital chain can actually generate high ROCEs, run the business efficiently, scale it up as a large format retailer, it's a very attractive investment opportunity area.
So on that note, we let you go. Appreciate you making time and speaking with DT now today. But time now to go across to our technical experts and get the closing trades from them as well. Naresh, you go first.
So would stick to Axis Bank. That's a stock which has been trying to hold on to that 1,000 mark. Out here, fresh 52-week high, fresh all-time high. So could see follow-up going forward.
That's a take coming in. Axis Bank is one of the stocks that Naresh likes. No surprise there. But what about you, Kunal?
So IT stocks from the defensive pack look attractive, and Infosys is something which I think at 1500, 1490 mark looks attractive for more of a BTST trade from current levels, expecting that if the market gets into a further corrective mode, the IT stocks could probably rise up by at least another couple of percentage points on the next couple of days.
Okay, on that note, we're going to take a very quick break. Come right back. We'll continue tracking the last half an hour of trade this afternoon.
Welcome back. Well, in terms of the broader markets, the stocks which are doing quite a bit today is Sundaram Finance. That stock is high by 8%. No new news flow as such, but that stock is definitely seeing a lot of buying action. 8% up move on Sundaram Finance. Yes, it's off the highest point of the trading session, but when the markets were tumbling, this stock was actually surging. So, interesting case there. Blue Dart as well. There was a brokerage note that came in this morning. On account of that, that stock is up by 4%. JB Chemicals is seeing a surge of 4%, and then Lemon Tree Hotel is the other stock that we are watching out for. On the losing side, Jindal Saw is down around 11%, and the rest of the defense pack. So Bharat Electronics is of course seeing that brokerage, downgrade reaction, but BEML is down in the trading session. A Cochin Shipyard, a Mazgaon Dock. All of these stocks are seeing quite a bit of reversal. In fact, that's the question that we posed to our battery of guests today as to what the prospects are of the railway and defense space, given the fact that on one hand, the order book has been strong, people are calling it the long-term play, but what is priced in the valuations is the big question. Let's go across and listen in to what our guests had to say on railways and defense.
Exuberance is very much evident, Nikunj, in my opinion, in these railway and defense companies. But again, I believe this is these companies are in that long haul moment, with the long runway. So so there can be, some of these great companies with great future. There can be correction, and it can price-wise correct 20-30%.
Every time people come in this market with a new theme, with a new dress and new concept, and ultimately that concept lasts for maybe 6 months or 1 year, or maybe 2 years sometime, and then they fizzle out. I'm not saying the story in those stocks are over. The story may play out maybe for a decade or so, but valuation is too high and there is euphoria in this market. I will not buy those shares, and this is what I can say.
I would definitely urge that this is not the time to just blindly get into something because there's a name defense or a railways or a shipbuilding or an EMS attached to it. Be discreet. There is, as I said, lot of opportunity in these sectors.
Whenever any rally becomes parabolic, it usually does not sustain, and that's clearly happened in defense and railway. And we have been recommending aggressive profit booking in both these spaces in the last few days, and we continue to recommend the same because I think this is just crazy because people are just factoring in too much into the future, discounting too much into the future, which I don't think is right.
Okay, let's take the conversation forward. We have Siddharth Khemka as well joining in on the show right now. Siddharth, hi, afternoon. Just wondering whether you're recommending booking profits anywhere. We are seeing quite a cool off in some of the cap good names, power financiers, railway, and even defense stocks.
Yeah, very good afternoon. So I heard the guests and panelists on your show. So basically, if you look at what has been happening is we have been sounding some cautiousness in the broader market, be it the mid caps or small caps, given that the kind of rally that they have seen in the last couple of months, and also because if you look at the valuations, a mid cap index is trading at about 24 times 1 year forward. 24 to 25 times roughly on a 1 year forward basis, compared to Nifty, which at 20,000 is trading at about 21 times on a FY24 P. So the premium is now about 15-20%, and that is a space where one needs to be cautious. We don't believe that there is going to be a full large scale selling in the mid and small caps, but a healthy profit booking is definitely advisable, and that is something that we have been kind of talking to customers. But it is not a broad based profit booking that we are advising. Selectively, some pockets which have done very well, where the valuations are kind of discomfort. Some of the space which has run up are the same names like shipping, defense, railways. Some of the railway stocks are still available at comfortable valuations of 20 or 30 times on a trailing basis, as we don't have a coverage on a lot of them. But as I said, some of them are trading at much higher valuation, and there is where the need to do some profit booking if someone has bought, and people need not fear of missing out. That is something that has picked up quite a lot in the last couple of days. That is something that people need to be very cautious about and not to jump into this space at this juncture.
Coming in as far as market is concerned, but the other big event that we are watching out for, and this is beyond the market for the Apple lovers, and that's the Apple's Wanderlust event, which is in focus. And the latest that we are hearing is that we might see the launch of a made in India phone. Let's go across to my colleague Samita to get more details on this one. Hi, Samita.
Anisha, in fact, this is the Apple season, and new iPhone 15 models are just a couple of hours away. Tonight, the big event will be beamed live from Cupertino, where CEO Tim Cook will be unveiling all the big new launches, which will include Apple Watches, iPods. In fact, two new watches will be unveiled, and 4 new iPhones will be unveiled. So you'll have the iPhone 15 and 15 Plus, which are the base models, and then the iPhone 15 Pro and Pro Max, which will be the more premium models, which will be more expensive. And these are the models that are expected to see a newer, faster processor as well, while the base variants might not see an upgrade in terms of processor. But yes, there will be a new dynamic island as well, which is a pill-shaped cutout display on top, which was a hit last year, if you remember, during the event. But now coming to Apple India's launch strategy, remember this is coming in at a time when Apple has, for the very first time, 2 retail stores in the country. Remember, just a couple of months back, CEO Tim Cook, in fact, stated in an earnings call that India presents a great opportunity, although it just has 5% of the market share, but the expansion opportunity is huge. He also mentioned India more than 5 times in that earnings call. So this is very, very crucial. Another very crucial thing to watch out for at tonight's event is that Apple could do away with the quintessential lighting charger and could opt for a USB Type-C charging port after a European Union strict regulations. Now, when will that be rolled out? Will that be rolled out just for the just for the European market, or for the Western markets, or for India as well? That will be an interesting thing to watch out for. So these are just some of the key highlights. Now, this is also coming in at a time when sales of iPhone globally have seen a slump, but the India market is a different story. India is a bright spot for Apple. We saw Apple CEO Tim Cook come earlier this year to launch to open these 2 retail stores as it's ramping up its retail strategy. In fact, the China market also has been presenting a challenge for Apple CEO Tim Cook, for the brand, because government Increasingly, government officers are being encouraged to not use Apple iPhones due to the stiff between China and the United States in terms of a tech war. Perhaps what's playing out is what analysts are stating. And yes, you could also see for the very first time made in India iPhone 15, which could be rolled out as soon as it's rolled out in some of the other markets as well, is what analysts and industry insiders are telling us.
Apple, Android. Which phone are you holding in your hand? Is it an Apple? Samita, which phone are you holding? Is it an Apple in your hand? Oops, noise in the Delhi studio. That's noise in the Delhi studio, otherwise she's gone. Bit of an Harry Potter there, okay, never mind. Yeah, just like Harry Potter happened. You know, Apple has got this thing that even when the links are discussed, something happens magical.
Wow.
That's Apple for you, right? I mean, just think about it. Apple is one of the most valuable company in the world. What do they give you? They give you a difference experience. Amazon is again one of the biggest companies in the world. What do they give you? Cheap, cheaper, cheapest. Apple is good, better, great. And they both coexist.
Most expensive.
Most expensive. So they both coexist. So there's customer for both. And the irony is that you go on Amazon and sometimes buy Apple. What happens?
Yeah.
Happens. For me, it's going to be Apple 15 made in India for the world. It's almost like, you know, deja vu moment, dream coming true. But Prime Minister Modi, I distinctly remember when he said that, you know, India should stop importing and India should start exporting. Not made in India for India, but made in India for the world.
Yeah.
And just that's the kind of, you know, impact we have. By the way, where are all the EMS stocks? I just want to see. That's again one space where the run-up has been quite extraordinary. Sirma SGX, Keynes India, again those stocks are correcting. So typical, anything which has been the high flyer, which has really been the big mover of late, that space has gotten completely down. I think Dixon is in FNO, right, Kunal?
Yeah, Dixon is in FNO.
How would you approach this stock now, given that the tide is turning?
I think it's been a very good stock, Nikunj. Over the last, I think, 3-4 months, the stock has recovered from 3,000 to 5,000 levels. So, and I remember, I think at those 3,000 levels, there was a lot of negativity surrounding the stock price. So it's managed to recover, not just recover that entire sell-off the stock had seen at the start of 2023, but in fact even go beyond those 5,000 levels for itself. Now the stock is, already at a multi-month high. I think it's almost at a 15 or a 18-month high for Dixon, closer to this 5,000 odd levels. Looks attractive, and I think traders should hold on to the long positions over here.
Very interesting. India Bull Housing Finance is down 10%. And that means it's locked down, right?
Yeah, it's an FNO, so it's not locked down as such, but the circuits will keep on opening.
Will keep on changing. Nuresh, you want to come in on India Bull Housing Finance?
So the stock has made a very large move and it is retracing the move back. So I would expect it to pause around that 160, 170 mark, which was the earlier support for the stock. But the stock has a tendency to make such wild moves. So if one has the risk appetite, maybe could look at it closer to 160, 170 to actually buy with a stop loss below 155.
So that you track Sundaram Finance. Any reason why that stock should be high by 8%?
So we don't track Sundaram Finance as of now.
Okay, any other NBFC names that you like?
Yeah, so if you look at overall banking and financial space, that has been one space which has kind of underperformed the market rally that we have seen in the recent months. And in that, banking is something that we keep liking it. We like HDFC. We believe that the company has delivered strong performance over the past 2 decades. The merger brings in synergies and the overhang of the merger is now behind. So I think that is one stock which should do very well from here. The other is Axis Bank. Again, we have been looking at their annual reports. The bank has strengthened its retail franchisee and has consequently pawned the bulk deposits. FY23, the Axis Bank posted 21% growth in CASA deposits, which was much higher than its peers. Asset quality has improved. ROA has recovered, which has been further aided by steady loan growth and moderation in OPEX. So we expect Axis Bank ROAs to improve to 1.8%, ROEs to almost 16% by FY25. That is something, again, within the banking space that we like. So these are some of the names that we like from the overall banking and financial space.
A couple of other stocks which are seeing, move. And today, sectorally, if there was really one sector that you were to pick out, that's actually pharmaceuticals. That's where you're seeing the brightest spots. I mean, sure, yes, TCS, Infosys are all holding out okay, and some of the other IT majors as well. But Divi's, Dr. Reddy's, most of these names from within the pharma pack, Sun Pharma included in there, they're all holding up very, very smartly indeed. Naresh, any opportunities within pharma to go long?
So it would be selectively Sun Pharma itself, which has been a low beta stock comparatively. So I would go with Sun Pharma. The stock is coming back to the levels of 1150, 1200, which was last seen in 2015. So that looks promising. TV's Labs actually came close to a breakout today. If it can sustain 3900, that would be a trend change. So I would be looking out for Sun Pharma and TV's.
Nifty again, what do we have there? And Naresh, I just want to start, perhaps address a very elementary point which we were discussing in the morning, that we've seen Nifty being in a range for a long time. It's been in this giant range for a extended period of time. And the range was, in a sense, we broke out of the range yesterday when we touched 20,000. So after a giant period of consolidation, if Nifty has gone and made a new high, do you think the rally could extend itself? And today's indication is a clear indication that the outperformance is real and here to stay.
So we saw a drip from 20,000 to 19,200. And it was a flag pattern. We gave a breakout of 19,500 and we moved to 20,000. That's the previous high. So a little bit of jitters out here would be normal. A previous high test. We even saw that happen at 18,800. We paused for 4-5 sessions and then made a move from 18,600 all the way to 20,000. So out here, ideally, we would expect 19,600 to hold and a dip to 19,800 remains a buy. And a stop below 19,600 and a target price of 20,500 on the Nifty. So the bias remains positive till we hold 19,600. And clearly, the signs are that large caps could take leadership, at least for the short term.
Coming in, Siddharth, from the entire industrial space and infrastructure space, is L&T the best bet? Or should one look at the likes of ABB, Thermax, Siemens as well?
So, Anisha, if you look at the entire capex theme has been doing well for past couple of quarters, and not only the order book has improved, the execution has also seen sharp improvement. L&T definitely is the proxy play to the India capex, India infra story, and that continues to lead from the front. But we have also seen good performance in terms of earnings growth from the likes of Siemens, ABB, which continues to do well. Private capex is something that we have been talking about for past couple of months, and that has kind of picked up not only the government capex, which has been supporting for last couple of years, but the private capex has also kind of seen inching up. A lot of capacity expansion programs announced, and that is something that we believe should help the broader spectrum of capital goods space as well. Something like Siemens, ABB, that also they have done well, and I think from here we could see a steady growth in terms of what the earnings delivery they could deliver. Market would kind of give that kind of return to these stocks as well. L&T clearly remains the favorite pick among the infra cap good space.
What do we have? Oil India, ONGC, typical outperformance in some of the PSUs, I think, is getting challenged. Kunal, another favorite for traders has been BHEL. Where is BHEL headed now?
So I think after today's sell-off, the stock should see more aggravated selling, at least from a very short-term basis. Now, the near-term average, so the stock had a tendency of coming closer to its 50-day moving average, not exactly touching it, but then missing it by a margin of 0.5% to 1%. That average is now closer to 106 or 108 for BHEL. So I'm assuming that in this leg of correction, the stock could retest its or come closer to its 50 DMA, where that should be around 110 mark. So at 125, 26 mark where it's trading right now, I think one should be prepared for at least another 15 rupees sell-off on the stock.
Where do you think the party is over? It's time the Cinderellas of the home, they should go home.
So power finance names, the ones which I think I've been highlighting, I definitely see some sort of an aberration in terms of the momentum, the volumes, as well as the price movement. So momentum has been missing. The volumes have been dry relatively as compared to the previous attempts of the stock making a new high. It's just that the inertia flow for the stocks and the sentiment booster had led into this new high for the stocks. But I believe in this leg of correction, you could expect a dramatic drop down to the stock prices. over the near term. I would also expect BHEL etc. to also go into a further correction of 10-15%. So maybe a near-term top could be in place into these kind of stocks at least.
Is it top or is it a sell?
Top.
Top means that book profits.
Yeah, so which means you're expecting 20 to 25% correction. So if the stocks
then
are
go
valued,
short. 25% correction, that's great correction.
BHEL, India Bulls Housing, I think so many of the stocks are in F&O ban. So you can only sell it maybe at the start of the day on cash market and then cover your
That's a typical. I mean, some of the stocks have just gone through the roof and then you realize, oh, then F&O ban. So then how come they're going up? That's because of the technicality at play. Now let's see what happens at the end of the day today, because when stocks are down 8-10%, forced unwinding will happen. At least in BHELs and India Bull Housing Finance.
The entire PSU pack. I mean, I was just looking at some of the railway stocks, Nalco, etc. as well, which are ticker is highlighting NTPC, and these have been some of the stocks which are all at life highs.
What were we discussing? That if you are a PSU, and if you are up less than 80%, we were discussing this yesterday. Then shame on you. But this entire fairy tales are great in storybooks. They don't exist in real life. I mean, it's not like Jack in the Bean stocks that you put a seed and trees go up. That was happening. And I mean, there's classic parabolic moves which were happening. These are classic telltale signs that excesses were getting created. When excesses they get created, shakeout will happen, weak hands will get out, and then new entrant will get in. Now whether you go down by 10%, 15%, you get into time-wise correction, price-wise correction, or the sector outperformance will continue. It's a judgment call, Aisha, really depending on the time frame you have. But in terms of this mad rush, which we've seen in some of the railway stocks and the defense stocks and the shipping stocks, I think the parabolic move could be coming to an end. Kunal, will I get it right? Will I get it wrong if I say like this?
No, I think it makes a lot of sense. And in this kind of a sell-off, the first thing which we typically tend to do is we book profits across the board for stocks which have run up, if I can use that word, obnoxiously high. So it makes a lot of sense to try and book profits over there. Now, whether to create shorts or not, that's part 2 of the strategy, because for that to happen, you need to see a decisive change of trend for these stocks. So you're not playing for that, just mild correction, maybe another 3-4-5% on the downside, because you're talking of these high beta stocks which have rallied significantly high. So you need to see a decisive change of evidence or an evidence that a decisive change of trend has happened. So it would be a bit premature to try and assume that this could be a strong sell-off mode for many of the stocks. We need to see the structure of how the markets approach into the profit booking mode. So the selling part, I would probably delay it by maybe another couple of days and see how the markets trend or which sectors and stocks they trend lower. But the profit booking part, I would definitely agree with.
Okay, so that's a take coming in on some of the PSUs, these names which have seen a massive run up in the last few days, months and weeks itself. What else is happening in the market? Well, if you look at the pullers and draggers in the market, it's TCS, which is your top contributor on the upside, followed by Infosys. So IT is clearly the pack, which is seeing a renewed buying interest. Siddharth, which are your top bets within IT? We were just speaking with Rakshit of Marcellus, and he talked about how they have been adding positions into IT. Is there any specific name that you like?
Yeah, Ansha. So I think IT, it's not a clear runway of growth. There is few more quarters where we could see sluggish growth. So it's not a full-fledged buy. It's a accumulate kind of a stance there. And within that also, if you look at some of the mid caps which have shown high growth, the valuations are a bit uncomfortable. So within the overall IT space, our preferred pick would be TCS, which is a market leader where we are seeing a steady, stable growth for the company, and we have a target price of about 3,800. So a decent upside. And beyond that, if you look at from the mid cap space, we like Cyient, which has been consistently giving us strong growth. So these two, if you mix up from a large and mid cap, I think could make a good combination from the IT space.
Okay, so that's the pick coming in. As far as the IT space is concerned, TCS remains a bit of a consensus buy. We have been highlighting how deal wins have been strong. In fact, there have been 4 large deal wins of over $1 billion in the last 3-4 months itself. 2 coming in from Infosys, 1 each from HCL as well as TCS. So that space looking quite well. And of course, in terms of the valuations as well, there's not much to complain. So one spot which might be showing a bit of being in the value zone. In terms of the other, stocks which are buzzing around, there's Honeywell Automation, there's ICICI Bank, Divi's Lab, Narayana Healthcare is doing quite okay. In fact, the pharma pack across the board, whether it's hospitals, whether it's diagnostics, is doing okay. Siddharth, within the entire healthcare space, which are the stocks that you're watching out for?
Yeah, Anisha. So I think Sun Pharma is a consensus buy there, and that is something that we also like. But if you take the overall healthcare space, hospitals is something that we have been very quite positive on. We like both Apollo Hospitals and Max Healthcare. Apollo, we saw strong earnings growth in Q1, 16% growth, led by healthcare, which was up 13%, and strong growth in the pharmacy business. We believe that the overall occupancy levels have been about 70%, which is good. It is doing good capex of about 2,000 new beds over the next 3 years. And on back of healthy growth, sustained profitability in both the healthcare services, plus achievement of break-even in the health business, we are positive on Apollo Hospitals. We currently have a fundamental target of 5,700. So that is something within the overall healthcare space that we like.
Okay, and as a house view, what's the top recommendations or any new initiations or any new mid-cap ideas, Siddharth, that you've managed to dig in?
Yeah, so I think within the overall space, broader space, we did initiate a few new ideas. Raymond was one such idea that we initiated recently. We believe that the company has strengthened its business in the last few years. It has got new senior leadership, restructured its group. The promoters have put in capital. If you look at the core strength, it has a good mix of strong established brands, be it Raymond's, Park Avenue, Color Plus, Ethnics, which it now plans to grow in a asset light, or you can say capex light franchisee model. The real estate business, which has been incubated in Thane, has been doing quite well. We have seen good execution there, good demand for its products. They now intend to expand to other regions as well. So that would also add on to the overall growth. In terms of consolidated numbers, if you look at the business is trading at a fair valuation. So if you do SOTP, the retail business trading at much lower valuation compared to its peers, which are trading at 45, 50 times. So overall, if you do the maths, I think that is one space where we are seeing incrementally strong earnings growth. The management's focus on separate businesses, be it the retail business or the real estate business, and that should do well according to us. We have a target price of 2,600 on Raymond's.
Okay, let's get in some BTST trades as well going before we wind up for the day. Kunal, what's on your list?
So there'll be two buy calls. The first one is about Sun Pharma, the stock confirming a breakout in the daily charts today. So targets of 1,200, stop loss at 1125, and the second is a buy on ITC for a target of 465, stop loss 447.
Okay, so that's the take coming in. Naresh, your view?
Buy on Axis Bank, stop loss at 990, target price of 1,030. Sell on Trent, which seems to be topping out, stop loss at 2,070, target at 1,950.
Coming in. Siddharth, before we let you go, your view on the entire auto space and the latest news coming in about that 10% additional tax. What do you make of it? It's still, of course, in the works and we don't have the clarity, but would spell a very bad news for Cummins, Bosch, M&M, Tata Motors, Ashok Leyland?
So yeah, Anisha, if it comes, definitely it's a negative, especially if it comes on CVs and tractors where you have only diesel engines and there is no alternative. If you look at some of the passenger vehicles company, especially the likes of Maruti, they have been clearly moving away their portfolio from a diesel heavy portfolio to a petrol and now CNG and hybrid technology. So I think if that comes and there is no clarity yet, but if it comes on CVs and tractors, it is definitely a big negative as it would increase the cost straight away by 10% and hit an area where there is no clear alternative. Yes, there are some EVs which have come, but I don't think the infrastructure is ready for CVs or tractors for the EV to penetrate. In the passenger vehicles, yes, more and more companies, even if this is not implemented, I think there is a clear message from the minister that gradually they have to move away from these fuels and start looking at alternate fuels. And that is something which could lead to more innovation, bringing more hybrid technology. And I think that could what drive the passenger vehicle segment there. So we have already seen a huge penetration of EV, specifically in the two-wheeler space, which will now kind of get driven into the passenger vehicle space as well. The Maruti is best suited with its portfolio of petrol, CNG, and hybrid technology, and clearly much ahead in terms of moving away from the diesel space. So that should do well.
Right, okay. Let's talk about how we're shutting shop for the day. Kunal, Naresh, Siddharth, all of you, thanks as always for joining in. And it's quite an interesting day considering we started off above the 20K mark, cooled off from there, slips up that level, recover a little bit, and that kept on happening throughout today. So closing sub the 20K mark and absolutely flat eventually. Minute bit of downtick coming in for the Nifty Bank, but I don't think it was the Nifty Bank which was the problem. The problem was within the broader end of the market. So while the Nifty is closing in just about soft, look at how the mid cap and the small cap index are actually shutting shop for the day. 3 to 4% apiece correction coming in individually on the indexes alone, and the individual constituents, of course, of all of these have bled quite a fair bit. BHEL has finally closed down with a 11% downtick. Indiabulls Housing is going home with a double-digit cut, 8.5% down for REC. PFC down almost 8% there. GMR Infra again down about almost 8% or so. Handful of movers which did sort of save the day for the Nifty: TCS, L&T, Divi's Lab, Ultratech Cement, Infosys, HDFC Bank, ITC as well to some degree, along with, of course, ICICI Bank, which saw strength. But yeah, all sectors within at least the F&O universe, they've all closed in the red. Maybe pharma or IT to some degree could be holding out, or relatively a better performer. But yeah, all sectors have closed in the red as we speak. Within the Nifty, of course, there's been a BPCL, NTPC, Adani Enterprises, Adani Ports, Coal India, Tata Motors, M&M, Tata Steel. They've all seen quite a bit of clobbering, as is Reliance actually. About 1.5% is the downtick that it's starting shop the day with. SBI as well drifted in the red, and Axis has closed in absolutely flat for itself. So yes, severe amount of profit taking, at least within the broader end of the market. The Nifty too felt the heat from that. Let's see what happens tomorrow. For now, it's a goodbye from all of us.